Hi everyone, welcome back to the channel. In this video, I'm going to tell you how to invest for beginners and become a millionaire. There's so much noise out there in the financial world, it can be hard for anyone to know what you should invest in and why you should invest. Should you buy crypto? Should you buy a house? Should you buy art, stocks, bonds, or should you day trade, right? So for most people, the fear of losing money is a real fear. So in this video, I'm going to divide it into 4 parts. Part 1 is the purpose of investing. Part 2 is why and how to invest in stock index funds. Part 3 are some common fears and how to think about investing. And part 4 is how to become a millionaire investor. Part 1, the goal of investing. So the goal of investing is for your money to work for you so that you don't have to trade your time for income, right? So if we're continually just working a job, we're always going to work that job unless we learn a way to replace that income with something that's more passive. So as we've talked about before, inflation decreases purchasing power over time. So I pulled up this article on Fidelity. So $100 in 1980 is now, inflation adjusted, is $413 today, right? So call it a 4-fold increase. And really that's a decrease in your purchasing power over time. So if you had put that money in a 3-month treasury bill, you would now have $694. If you had put that in a bond index, you would now have $1,778. So your $100 over that 44-year period has grown to $1,700. Not that impressive. So if you put in $100 into the stock market, and this is the S&P 500 index, you would now have $17,081. So this really shows the power of investing and how keeping your money in a savings account or even a bond fund really isn't safe because it's not getting you anywhere, right? So in this instance, your bonds are barely beating inflation. So the basic concept here, there's two ways investments make you money. Number one, they generate income. So whether or not they pay you out this income, so when you own stocks, you own a piece of a business and they are generating cash, right? That's what a good business is, earning money. So they are generating that income, which then makes the business or the stock more valuable over time. So if they grow their earnings and grow that income, someone's willing to pay more for their business, right? So the second way, and I just kind of alluded to it, is capital appreciation. So not only is that asset generating more money, it's now worth more, which it appreciates because it generates more income. So I think the best assets both generate income and appreciate. So if we look at real estate, which is a simple example that people can understand, if you have a rental house, right, it both generates income via your rent payments and over time it appreciates. Over time, real estate, the value will go up with or a little bit above inflation. So you're making money from the income from the rental and from the appreciation of the asset. So if you look at other assets like gold, crypto, art, for example, these generally don't pay any income, right? So the only way you make money from these is if the price goes up over time. And generally that only happens with inflation or if someone's willing to pay you more for it. So this is why I don't prefer those assets. And over the long run, we can see that they just don't return the same, except for crypto. I mean, people love crypto, but in my opinion, there's no real value to it at this point. So it's hard to place a number on it. Part 2, why and how to invest in stocks via index funds. Step 1 is like and subscribe to the channel. It'll really help you buy index funds. But seriously though, I'd appreciate it. My name is Nate. I'm an engineer and I'm an investor, and welcome to the channel if you're new here. So when you buy stock, you're really buying a part of a business, right? So if you buy Apple stock, you own a piece of that business and any money they make is partly your money. So the ways to buy stocks You have to use a broker or a platform. So companies like Vanguard or Fidelity or Robinhood are platforms or brokers so that you can purchase stocks. Another way is obviously in a 401k. Generally, 401ks, IRAs, you may not have the option to buy stocks individually, but you can buy index funds. So there are a few ways that stocks generate returns, as we talked about before, similar to a real estate purchase. One is capital gains. So as those companies make more money, the value of the company becomes greater and greater. And at some point, if you want to sell, you should be able to sell for a higher price if that company has made a lot of money. Another way that you can make money with stocks is through dividends. So companies generate cash, as mentioned, so they generate more and more income. And some companies, more mature companies, decide to pay out a portion of their earnings as a dividend. So this comes as usually a quarterly payment to the shareholder. And so even if you own an index fund like an S&P 500, you will get dividends. You'll get quarterly dividends. Now we're going to talk about stock picking versus index funds. So most professional money managers cannot beat a simple S&P 500 index fund. So this article here, 88% of professional fund managers get beat by this simple strategy. And this simple strategy is simply buying an index fund like the S&P 500. So Warren Buffett famously put about $1 million bet with some hedge fund managers over a 10-year period. And he bet them that he'd put $1 million into the S&P 500 and they could use their strategy, and that over 10 years he would outperform them. And he killed them all. I mean, it wasn't even close. So an example here, S&P 500 index fund. Vanguard famously pioneered the index fund with Jack Bogle. So this ticker symbol, which is how you look up a stock or a fund, is called VOO. So this is the S&P 500 index. So let's see. Let me show you what an index fund is. So right here, this website is morningstar.com. So we type in VOO, and this is the Vanguard S&P 500 index fund. So this is a simple and inexpensive way to get exposure and purchase the S&P 500. So you can see right here, the expense ratio is 0.03%. So some active funds will have an expense ratio of 0.5%, 1%, even higher. They are getting lower because they've been pressured by index funds. So let's see. I want to show you what an index is, right? So this index, it's basically a basket of stocks. So the S&P 500 are the 500 largest companies in America, and largest is by market cap, so market capitalization. So the largest companies are worth the most money, right? So Apple might be worth $3 trillion, where Coca-Cola might be 500 billion. So it's weighted towards the companies at the top, and this ends up being an advantage. So if we look at the portfolio, and the point here with an index fund, these stocks generally don't change very much, right? So during the year, there'll be a few companies that might leave the S&P 500. There'll be a few companies that might join. And so these index funds then have to sell the companies that leave and then purchase the stocks that join the index. So you'll see right here is 504 equity holdings. It's not exactly 500 only because there's a few different classes of certain stocks, like Google stock, for example. So right here, we'll tell you the holdings. So, and this is as of October 31st, and it'll tell you the percentage of the portfolio that stock is, right? So out of 100%, NVIDIA right now, because they've done so well, is 8.47% of the S&P 500 index. So if you put $100 into the S&P 500, $8.47 of that is going to NVIDIA stock, right? So number 2 is Apple at 6.88%. And, on down the list. So these are all very large companies. So Alphabet, this is one of the ones I mentioned. Alphabet is Google's parent company. So Alphabet has 2 different classes of shares, Class A, Class C. So you'll see those 2 here. So 2.8% and 2.26. So if you add those up, so Alphabet or Google is about 5% of the index currently. So this is how you can, see what's in your index fund, right? Tesla, all the really large companies are at the top. But you have diversification because you have 500 stocks, and you generally have great performers that rise to the top, right? So the most a company can lose when you hold an index fund is a stock can go to zero. And realistically, before that stock goes to zero, it's going to fall off the index. And then the most a stock can gain is infinite, 1,000%, 10,000%. Over time, those numbers are very large. The benefit of an index is you benefit from all the companies that do really well, while the ones that don't fall off the index. So how to get started? So for most people, the first step would be if your company has a 401k and they match part of your contribution, you really want to take advantage of that. So one way to get started there with index funds is to look at your 401k and look for something called an index fund, right? So most plans have either S&P 500 index fund or a total US stock market index fund, or if you're in another country, hopefully some type of index fund. And generally the way to spot an index fund, if it's not obvious, is to look at the expense ratios. If they publish those, look for the very low ratios, and those should be the index funds. So if we look here, there's some different accounts, right? 401k, 403b, 457. So for all of those, the 2025 contribution limits are $23,500. So that's what you can contribute, and then your company can match beyond that. If you're doing an IRA or a Roth IRA, the limit's $7,000. So these are a few different account types, and then once you're in those accounts, then you still have to choose your investments. So the investment is the index fund, but the account is where that money is actually held. Alternatively, you can open a brokerage account through Robinhood or Fidelity, etc., and you can open what's called a taxable brokerage account, right? So this is just a standard brokerage account. You don't have any of these limits. You can put as much money as you want in there, but there aren't any of these tax advantages. So, for example, 401k, typically you put in money pre-tax before you pay taxes. And then a Roth 401k or a Roth IRA, you're putting money that's already been taxed, but then it grows tax-free and you can withdraw it tax-free later. So those are a few of the account types. Part 3, common fears and how to think about investing. So for a lot of people, there's a real fear of losing money, right? So in the stock market, you can see on this chart here, there are times where it drops 20, 30%. COVID was one of those times. 2022 was another time. More recently, that happened as well. But the key is you only lose money if you sell during those times. So if you just keep holding and ignore the noise, and especially if you're in the stage where you're investing every month with every paycheck, those drops in the market are actually a blessing. So you're buying more shares at a lower price, and then guess what? The graph keeps going up to the right. So it's really about knowing what you own. So when you own the S&P 500, you have essentially all the biggest businesses in the US and all the people that work at those companies going to work for you every day to make you richer. So you still own the same number of shares. So just because the market drops, it doesn't mean you have less of an investment, right? That only comes, if it's time you need to sell that investment to live off. So, it's really a rigged game if you think about it. So an index fund, as I mentioned, the most a stock can lose is go to zero, and the upside is infinite. So if you just hold this index, you're over the long term, you're going to make money. All right, part 4, the moment you've all been waiting for, how to become a millionaire investor. So I pulled up here our trusty compound interest calculator from NerdWallet. So if we look here, we can enter some numbers, right? So let's look at a $500 investment, and we're gonna contribute $500 monthly. We're gonna do that for 30 years. And in general, the S&P 500 returns around 10% a year on average, give or take. So right there, $500 a month, most people's car payment, for 30 years at 10% return with an initial contribution of $500, you would have $1.1 million. Not bad, right? So for some people, that's like, well, 30 years is a long time. Come on, Nate, I want to go a little faster. All right. So let's see. Instead of that, you want to get there a little faster and you have a good income. Let's start with a $2,000 deposit. And let's say we only want it to take 20 years, right? So 20 years, same rate of return, 10% monthly. But instead of 500 a month, we're going to have to contribute more if we want to get there faster. Let's put in 1,300. There we go. So 20 years, initial deposit of $2,000, $1,300 a month. Put it into a stock market index fund, and you are officially a millionaire. Well, that's it. That's all I have for today. Thank you for watching. I appreciate it, and I'll see you in the next video.